Debt can make you rich when you use other people's money to control assets that appreciate and create cash flow that grows your net worth. Good debt creates leverage for a small monthly fee. You can control an investment worth many times the monthly payment. Your gain is a percentage of the asset you control, not your income. Hey there, welcome to the Daytime Dollar, where we talk about financial strategies and how small changes can make big improvements. If you are new here, subscribe to my channel and hit the bell icon. So in this video, we will discuss 5 ways rich people make money with debt. So let's get into it. How does debt make you rich? Debt can make you rich when you use other people's money to control assets that appreciate and create cash flow that grows your net worth. Good debt creates leverage. For a small monthly fee, you can control an investment worth many times the monthly payment. Your gain is a percentage of the asset you control, not your income. Many businesses start with business loans so the owner can get access to capital in the first stages of opening and operating. While the banker owns the right to the interest on the debt and the payments, the business owner owns the business itself and the value of the future profits and cash flow. Debt gives people the capital they need to create assets of value. With debt and credit, everyone can be a capitalist. Here are 5 powerful ways to use debt to build wealth. 1. Leverage in real estate. Buying real estate allows you to leverage your capital by multiples of 20 with 5% down payments or multiples of 1,000 with monthly payments. For a down payment of $10,000, a real estate investor can own a $200,000 house with a $2,000 monthly payment. Real estate investors make returns on the full amount of the loan, not just the money put into the investment. If the piece of real estate goes up 20% in value from $200,000 to $240,000, then the $10,000 down payment creates a 300% return with the $40,000 investment return. Debt can also be used to buy monthly rental properties or houses to be used as an heirloom to create cash-flowing assets for monthly income through leverage. The returns in cash flow are on the total debt, not the money invested in the property, creating great returns. 2. Leverage buyout. A leverage buyout happens when the buyer or buyers of a company takes on a large amount of debt as part of the purchase process. The buyer will use assets from the purchase company as collateral to acquire the company, with plans to pay off the debt later after the buyout using future cash flow from the company. After a leveraged buyout, the buyer ends up with a controlling interest in the target company. 3. Short selling. Selling short reverses the normal order of buying and then selling stocks. Selling short means selling something you don't own. When you sell a stock short, you borrow the stock from your broker and sell it to a buyer. You then owe the broker the shares. You receive cash from the sale, but have to use it to buy the shares later to pay back your broker for the loan of shares. You're long cash and short the shares on a short side trade. You're in debt for shares using the credit available in your margin account. When you buy to cover the short position, that will be your debit purchase price to buy back the shares you were short in the open market, and your broker can return the shares to the account they were borrowed from. This is all done electronically today and is computerized and automated. A short seller reverses the sequence of trading. They sell first and then buy back later. If you sell short for a higher price than you buy it back later, you got a profit using debt. While you were short a stock, you will also have to pay margin interest on the position size. You will also have to pay any dividends due on the stock during the time period you are short. This is how traders can make money in both directions of the stock market when it goes down as well as up. 4. Margin account. A margin account is a type of brokerage account where the stockbroker lends the investor cash or shares, using their account as collateral to purchase securities. Margin trading is when your broker adds buying power to your account to increase the size and number of trades you can make. Margin can be used to add leverage to your trades or for a faster turnover without waiting for them to clear after entering and exiting. If a margin is used to increase the size of your trades, then your results are amplified. If you trade twice the size of the position you would have traded without margin, then your wins are twice as big, but also if it's a losing trade, it would be twice as big of a loss. Margin accounts allow investors and traders to generally double the size of their total trade position sizing if the stocks they buy can be used for full margin. Margin, more importantly, allows day traders to maintain buying power without needing to wait for all their trades to clear. 5. Using debt for living expenses. Investors can pay living expenses using debt to avoid income tax and taxable events like selling assets for capital gains. For example, they can use a margin loan on their portfolio holdings with their broker without needing to sell any of their stocks at the moment and then pay it back later by selling stocks that are down, creating no capital gains tax. High net worth individuals can also live off lines of credit backed by their assets and only pay off their loans from sources with optimal taxing structures. Let the sale of a personal residence that is not taxable in most states, selling losing investments, dividends with a lower tax rate than income, margin loans, or capital gains from stocks that have a lower tax rate than a high-income tax bracket. How do billionaires live off loans? An example of a wealthy person making money from debt by optimizing their tax liability. Let's look at Elon Musk as an example. When the richest man in the world needs some cash, he can borrow money and use debt for living expenses or try to acquire companies like Twitter. He can use his holdings of Tesla shares as collateral for credit lines as an alternative to selling his shares and then having to pay capital gains taxes on the profits of a sale. His pledged shares of Tesla serve as an ongoing credit facility, giving Musk access to billions in cash whenever he needs it for any purpose. So guys, that's all about today's topic. Hope you guys like this video. See you soon in the next video. Goodbye.